Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 22nd, 2026. Hey, I hope you're doing well. I hope you are enjoying your weekend, and I hope you had a good trading week last weekend. Thanks for coming to my weekend review podcast. I hope and I think that you're going to find it helpful. So the format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades, all the positions that I made and have from last week. I'm going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences were, how I position size based upon the current market volatility of the market, where I placed my emergency stop, where I placed my end of bar stop, how I take partial profits if the market does start to move my way, what happens when I get to trailing stop mode, and then ultimately how I exit the position if and when we get to overbought levels. Hopefully that gives you an idea of how I look at trading, how I stock trades, and then how I enter the trades and manage the trades. So when I entered, why I entered, and how I'm going to move, or how I'm going to manage moving forward. After that, we're going to spend a few moments talk about trader psychology. Most important skill in trading is the ability to create a plan and then, more importantly, to follow the plan. There are a lot of different trading approaches, a lot of good ones, but if you don't follow the rules, what good is it? So it's extremely important. It's the most important skill in trading, the ability to follow your plan. After that, I did go down through my master watch list last night, and I have identified some potential trades that I'm looking for next week. Now, these trades are not where they need to be yet, but they are getting close to some confluences of support. And so whether those are order blocks, major moving averages, certain RSI levels, double bottom bullish MACD divergences, or ideally all of those kind of coming together in a confluence. So I'm going to share those. Hopefully that will be helpful for you, give you an idea of what I look for, and then how I'm going to set the trade up. So if you do find anything that is helpful or valuable to you in this podcast today, I really would appreciate if you would just take one moment, hit the thumbs up button. It really helps the channel, lets YouTube know that there's some valuable content, and I would really appreciate it. So let's get the U.S. legal disclaimer out of the way, and we'll come back and we'll get started. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. First open position I have here is SPCX, SPCX. So this has been quite a good trade. I did enter SPCX here on the 6th of August at 114.89. So the question is, why did I enter here? We had SPCX that just went down almost for an entire month, and I had a lot of people ask me, hey, should I buy SPCX? I said, I want to wait for SPCX to change market structure from bearish to bullish, and that's exactly what it did, and that's exactly why I entered. So the real question is, why did I enter here on the 6th of August? Well, let me bring your attention to this green box here. This green box is what is called an order block. People use different terms: order blocks, demand areas. I like to look at these as smart money areas. But in order for one of these order blocks, or whatever you want to call them, to form, we need the following pattern. It starts off when you have a swing low. A swing low right here on the 28th of July, a swing low is simply a low that has a higher low to the left and a higher low to the right. So here on 7/28, we have a swing low. Now, after you have a swing low, the next thing I need to find is a swing high. A swing high is the opposite. A swing high is a high that has a lower high to the left and a lower high to the right. So now we have 2 of 4 of what we need. We have a swing low, we have a swing high, and then after that, we need another swing low that is lower than the first swing low. And this happens here on the 3rd of August. It is a swing low because we have a higher low to the left and a higher low to the right. And this second swing low was lower than the first swing low. So we have 3 of 4. We have a swing low, we have a swing high, we have a lower swing low. Now, when you have those 3 in place, you have to go back to that first swing high. And if in the future the price moves up above that first swing high, now you have changed market structure. So we have a swing low, we have a swing high, we have a lower swing low, and then the very next day we have this huge move up that took out that first swing high. Now we are in a bullish market structure. Now, looking forward, we should go up. But as soon as you change market structure, there's some kind of tendency. It doesn't happen all the time, but there is a tendency of once you change market structure to have a pullback before you have a leg up. And that's exactly what happens. So swing low, swing high, lower swing low, market structure change. Now, when you have this market structure change, now you can define the order block. And the way that I do it, people do it different ways, right? There's people really do these things differently. But what works for me and the way that I use it and the way that I teach it is simple, and it works quite well, is once you have that market structure change, I look for the lowest closing bar prior to market structure change. And this happened here on the 31st of July. So I'm highlighting the high and the low of this bar because it's the lowest closing bar prior to market structure change. So I highlight the high and the low of that bar, and I bring it into the future. So swing low, swing high, lower swing low, market structure change, and then we had the pullback into the buyable area. Now, there are multiple ways that you can enter an order block. You can enter the order block with the rejection of the high of the order block or the low of the order block. You see, the previous day, I could have entered the trade here because during the day, it went under the order block and then closed back in it. That is a rejection of the bottom of the order block. Now, I didn't do this, but if I would have got a better price. But I waited until the next day where we again rejected the bottom of the order block and we rejected the top of the order block. In addition to that, we have what is called a V1 formation. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 has to go under bar 1's low and close above bar 1's close. It's not a primary signal. A rejection of the order block is a primary signal, but a V1 or a V2 is a secondary signal. I wouldn't take the trade just based upon the V1 or the V2, but it adds bonus points to the trade to have the V1 and V2. And by the way, if you want to learn more about V1s, V2s, I have a good video on my YouTube channel about it, and it will explain in more detail. But I use V1s and V2s all of the time. Okay, so I entered here on the 6th of August at 114.89 because we rejected both the bottom of the order block and the top of the order block. Like I said, plus we had the V1. So, okay, there's my entry, 114.89. Now, as soon as I see that signal, I have to decide how many shares I'm going to buy. And I mentioned at the beginning of the podcast that I really want to base my position size based upon the current market volatility of the market. So to do this, I need two inputs. The first input is how much do I have in my trading account? Let's just say I have $100,000 in my trading account. What I do personally, I use 1% of that. So 1% of $100,000 is $1,000. That is the maximum I am going to risk on this trade. If you have $200,000, then your maximum loss is $2,000. If you have $50,000, maximum loss is $500, right? So it works for any amount. So the first thing I need to know is what is my maximum allowed loss on this trade? For me, it's 1%. So 1% of $100,000 is $1,000. The next thing I do is I look for the value of the 2ATR. This basically is showing you what the volatility is of this particular market. If the number is higher, you have more volatility. If the number is lower, you have less volatility. So I take the $1,000 divided by 19.0. 2.97. This tells me, Greg, you should buy 50 shares of this stock based upon your account size, and you're willing to lose 1% of your account maximum on this trade, plus the volatility is 19.97. You should buy 50 shares. Okay, so I buy 50 shares here, 114.89. The first thing I do is I need to find my emergency stop. And it's very simple. It's just my entry price minus the value of the 2 ATR that I used in the equation. And so entry price minus that 2 ATR value, I place this red line down here. This is my emergency stop. So in the future, if it ever gets here and touches this line, I am out. And how much have I lost? I have lost $1,000. I have had 50 shares that have gone down essentially $20. That's $1,000. Okay. Now, it's not fun to lose 1% of your account, but you can recover from it. But the good news is I don't hit this emergency stop very often, only about 5% of the time. The other 95% of the time, if I have a loss, it's not going to be because I hit my emergency stop. It's going to be because I hit my end of bar stop. So let's talk about the end of bar stop. Emergency stop's down here, $19.97 below. But my end of bar stop is going to be closer to my entry, so therefore the loss is going to be less. And on this particular trade, if it closes below this order block, below the green box, that is my end of bar stop. And instead of losing 1%, maybe I'll lose 1/4%, or 1/3%, or 0.5%, or 0.1%. Just depends how close you are to your end of bar stop when you enter the trade. And I always try to take trades where I'm just as close as possible to my end of bar stop. So if I'm wrong, I could be wrong the smallest. Okay. So we have a swing low, swing high, lower swing low, market structure change. It defines the order block. After the market structure change, it comes back down, rejects the bottom and the top of the order block. I enter here, 114.89. I place my emergency stop 2 ATRs below. My end of bar stop, close below the low of the order block. Now, the next thing I do is once I've entered the trade, I know where my emergency stop is, I know where my end of bar stop is, I take my entry price plus the value of the 1.5 ATRs. Right now it's $14.92. And I add that value, the $14.92, to my entry price, and I place this orange line up here. This is my trailing stop mode. You've heard in trading, if you have a trade and it starts going your way, you want to start tightening up your stops. And this is what this is for. So once I enter and I get to my trailing stop mode, it doesn't mean I do anything at the moment. It's just that once I cross that threshold and I get to trailing stop mode, now I'm in trailing stop mode, meaning that in the future, if I have a close below a previous bar's low, I will exit half of my position. So you've heard, okay, once the stock starts moving in your direction, you want to tighten up your stops. Well, I don't physically move my stops up, but if I go into trailing stop mode and then I have a close below a previous bar's low and I sell half, selling half has the same effect of moving the stocks up because now I have half of a position. Okay, so everything I have talked about so far as emergency stop, end of bar stop, going into trailing stop mode, these are all defensive rules, defensive behaviors. In other words, if it moves against me in any way with emergency stop, end of bar stop, or trailing stop mode, I need to sell something or do something in a defensive manner, which is fine. You know, in sports, you need to play defense. In trading, you need to play defense. But I'm really a fan of wanting to play offense and defense as well. And the way that I play offense, not just defense, but offense, is that I take partial profits each day if the market moves a certain distance from the previous bar's close. So let me illustrate this to you to show you exactly how I do this for this coming Monday, because it changes every single day. For Monday, I simply take the closing price, which is 136.97, and I refer back over to the value of the 0.45 ATR. Right now, the 0.45 ATR is $4.49. So I simply take the closing price plus the 0.45 value, add those together, 136.97 plus 4.49, and the first profit target for me for Monday on this trade is 141.46. So let's put this number in, 141.46. There is my first profit target for Monday. Now, I always place 3 profit targets. So I showed you how to place the first profit target. Closing price plus 0.45 ATR value is 141.46. All I do is take the first profit target, 141.46, again, add the 0.45 to it, plus 4.49. My second profit target for Monday is 145.95. There is my second profit target. And to get my third profit target, I take my second profit target, 145.95, and again, add the 0.45 value to it, plus 4.49. My third profit target for Monday is 150.44. Okay, so there are my 3 profit targets for Monday. So the question is, how much profit do I take? It's very simple. I just take 10% of how many shares I go into the day with. If I go into the day with 40 shares, I'm going to take 4 at the first profit target, 4 at the second, and 4 at the third. So if Monday SpaceX goes down, well, I'm not going to hit any profit targets, right? So I'll have the same amount of shares going into Tuesday. But if Monday it does, has a decent little day up, okay, maybe I hit 1 profit target, I take 4 shares off, that reduces my position size, I've locked in those profits, market can't take those away from me. There's a lot of advantages of taking partial profits. And really what it does, I think one of the main advantage is that you continually reduce your position size, and with the lower position size, you have less stress. With less stress, you're more likely to follow your process. And the other thing too is, like I said, if you take those profits, you lock those in. The market can't take those away from you. And if SpaceX reverses dramatically from here, okay, I may still have a loss in the trade, but it's mitigated because I have fewer shares. So I'm a huge fan of taking partial profits. So, all right, those are kind of the basics of how I set everything up. So let's just go day by day and see how how I manage this trade. So again, why did I take the trade? I rejected the order block, the bottom and the top of the order block plus the V1. What's the order block? Swing low, swing high, lower swing low, followed by a market structure change, waiting for a pullback and rejection of the top of the order block, the bottom of the order block, some kind of moving average inside the order block. So I entered here 114.89. I position sized correctly based upon my account value, my maximum allowed loss, and the current market volatility. I entered, I placed my emergency stop 2 ATRs below my end of bar stop. It's a close below the low of the order block. I placed my trailing stop level 1.5 ATRs above and took the trade. The next day, huge move up. Great start to the trade. I hit 3 profit targets on the way up, which was nice right off of the bat. And I also got to trailing stop mode. Now, just because I'm in trailing stop mode doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to take off half. Okay, so had this huge day up, hit 3 profit targets, got to trailing stop mode, don't do anything. Next day, up again. Sold a profit target into that strength. Next day, no profit target. We had a pullback. And then we had another huge surge up where, again, I took partial profits. I think I hit 3 of them again into this strength up. Okay, so taking advantage of the market wanting to allow me to sell some shares into it, I give them some. Okay, next day we're down, next day we're down, next day we're up, hit a profit target, down, down, and then here on the 20th is our first close below a previous bar's low. After reaching trailing stop level, what do my rules tell me to do? sell half of the remaining shares that I have, and that's what I did for a gain of 14.22%. Friday was up again, but not enough for a profit target. So I did sell half on Thursday. Now I have fewer shares, obviously, but it's kind of nice because now the pressure's off. And going forward, if SpaceX continues to go up, I will continue to take partial profits if the market gives them to me. If this heads straight back down and closes under the bottom of the order block, well, of course, I'll have to get out of the trade. But if that happens, I was very grateful, and it was a very good idea that I sold half here, because it would really, honestly, on this at this point, it would be tough to lose money on this trade. All right, so sold half, remaining shares. I'm sorry, I sold half for a gain of 14.22%, and the remaining shares that I have up 16.08% on this trade. So good example of an order block, using an order block trade. IBM. Okay, so IBM has also been a good trade. Most of the trades that I have consist of an order block. I would say 90% of them. But this particular trade on IBM, I did not use an order block, but I still took the trade. I took the trade back here on the 23rd of July at 206.65. Why did I buy here? So no order block. This is a combination of a V1 entry with a deep dip buy. And so deep dip buys is one of the strategies that I use and that I teach. Deep dip buys have to do with rejections of the 30 RSI, rejections of the 300-day moving average, rejections of the 250-day moving average, or the rejections of the 200-day moving average. On this particular day, the reason that I took the trade was that during the day, we were under a 30 RSI, but we closed back above the 30 RSI. This is called an intraday rejection of the 30 RSI. In addition to that, we also had a V1 entry, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. Again, that's a secondary signal, not a primary signal. The deep dip buy under or intraday rejection of the 30 was the primary, so I had a primary signal and a secondary signal. So I entered here 206.65. I position size based upon 1% of my account and the volatility. I placed my emergency stop 2 ATRs below. My end of bar stop on this particular trade is simply a close back below the 30 RSI. Remember, we were under the 30 RSI, but then we closed back above it. However, the next day, if it had closed at 29.99, I simply would have gotten out of the trade. I placed my emergency stop 1.5 ATRs above my entry, and here we go. What happened? The next day, up. Trade starts off good, hit a profit target into the strength. Perfect. Next day, up a little. I honestly can't remember if I hit a profit target or not here. The next day, up big. I certainly hit a profit target, took some profits into that. Next day, it actually ended up down a little bit, but I did get to my trailing stop level threshold. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I get out of half. That happened the very next day. This is the first close under the previous bar's low. After reaching trailing stop level, what do? I took off half, and I took off half for a gain of 6.76%, but I still have half. Next day up a little, no profit targets. Next day up, can't remember if that was a profit target. Next day up big, certainly a profit target. And then we kind of moved gradually sidewards, but up. Really a lot of sideways motion here. And I don't think I've hit a profit target since then. Again, the half that I took off for a gain of 6.76%, and the remaining shares that I have at this moment up 12.31%. So going forward, if it continues to move up, I will continue to take partial profits. If we get to a 65 RSI level, then I have other rules to tell me to potentially just close the trade. If we head back down, I will have to get out of the trade, if we close back under the 30 RSI. So good trade. Half gain, half locked in at 6.76%. The remaining shares up 12.31%. And again, this was a combination of a deep dip buy as the primary signal in combination with a secondary signal of a V1 entry. So this trade has worked out very well. Intel. Okay, so I took Intel here on the 3rd of August at $91.03. Why? Very similar to SpaceX, we had a rejection of the bottom of the order block and a V1. You can see during the day, we were below the order block. By the end of the day, we closed back in the order block. That's the primary signal. In addition to that, we had a V1 entry signal. I entered here 91.03. I position sized correctly based upon the volatility. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this green box, a close below the order block. I entered very close to the bottom of the order block, so my risk to reward ratio is very good. I placed my 1.5 ATR trailing stop level above, and the next day, boom, took off like a rocket. Perfect. I hit multiple profit targets into that strength. Right off the bat, I'm shedding shares and reducing my position size, okay? The next day, we are up a little bit, and we crossed the threshold. We crossed the trailing stop threshold. I don't do anything. I'm just now waiting for a close below previous bar's low and to exit half. Next couple days, we kind of move sideways. And then here on the 10th was our first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the shares that I had remaining for a gain of 6.64%. And again, by taking a half of the shares off, this has the effect of moving all my stops up, okay? But I still have half. Next day, up a little. Next day, nice up day. Hit another profit target into that strength. The next day, up again. Hit profit targets into that strength up. Couple days of sideways motion, no profit targets. And now over the last 4 days, we have really come down. So the remaining shares that I have on this position, the remaining shares are down 0.99%. But this is a very good example of why it's important for me to take partial profits, because the remaining shares are down essentially 1%, but I'm still really up on this trade. Why? Because I took profits much, much higher when the market gave them to me. I went into trailing stop mode and sold half at much higher profitable levels than it is now. So yes, overall, I am certainly up on this trade, but it's a good teaching example of why it's important for me to take partial profits and why it's important for me to go into trailing stop mode and take half, because if it does come back, you've mitigated that and you can still have a profitable trade even with that. I mean, like I said, this is down 0.99% on the remaining shares, but of course, I'm still up on the trade. And by the way, Monday, if this closes under this order block, I'll simply be out of the trade. Okay, so the remaining shares there down 0.99%. Tesla's been a really good trade here, and it incorporates a lot of the signals that I use and that I teach. I entered Tesla here on the 30th of July at 308.81. Why? Okay. First of all, we rejected the bottom of the order block. Okay, so that's a primary signal. Secondly, we rejected the 30 RSI. The day before I bought this, we closed below 30 RSI. The day that I bought this, we closed above 30 RSI. So we have two primary signals. We have a rejection of the bottom of the order block. We have a close under, close over the 30 RSI, which is a deep dip buy signal. And in addition, I'm going to zoom out here. I'm going to show you one other piece of the puzzle. It's this trend line, this long-term trend line here. And so these are called megaphone trend lines. Megaphone trend lines are when you connect a swing low in the past to another swing low that's lower than the first swing low. So I connect this swing low to this swing low. I run that trend line out into the future, and very often, so we have 2 points. We have point 1 here connected to point 2 here, and then the trend line runs out. So this is point 1, point 2. Very often, if and when you touch that trend line, you touch the slope of that trend line the third time, that's I mean, not all the time, but more times than not, the market will give you some kind of reaction there. And that's exactly what happens. So this shows you the importance of looking for those confluences. What are the confluences? Rejection at the bottom of the order block, close under, close over the 30 RSI, deep dip buy, and we rejected this trend line. The previous day before I bought the trade, we closed under it. The day that I bought the trade, we closed over it. That's the rejection of the third point touch on the megaphone trend line, in addition to the order block rejection and the rejection of the 30 RSI. That's why I entered the trade. So I entered at 308.81 position size, bought the correct amount of shares, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. Place my 1.5 ATR trailing stop level above. Next day, up a little. No profit targets, nothing to write home about, but it was up. Next day, boom, we had a nice big day up where I did hit some profit targets and took advantage of that strength. Had a few small down days. Here on the 7th, we had a big up day where I did hit partial profits. 2 days later, we touched trailing stop mode. That means now in the future, if I have a close below previous bar's low, I will sell half. That happened the very next day. This is the first day we have a close below a previous bar's low after reaching trailing stop level. I took off half for a gain of 5.59%, but I still half. The next day up again. Great. Hit some profit targets. Next day up again. Great. Hit some profit targets. Then we had a couple of down days. Here on the 19th, I hit another profit target. And then here last Friday, I hit 3 profit targets into that strength. So the remaining shares that I have at the moment on Tesla are up 14.73%. So it's been a really great trade. Again, this was a combination of a rejection of an order block along with a deep dip buy signal, along with a rejection of the megaphone trend line. Oh, and a V2. I've talked about V1s, but not V2s. V2, again, not a primary signal, but a secondary signal, consists of 3 bars. Bar 1, bar 2, bar 3. 2 goes under bar 1's low. 3 closes above bar 1's close. So hugely important buy signal. Doesn't mean it has to be positive. Clearly this one was, but major primary signals and major secondary signals all combined. This setup is a very high probability trade with a good risk to reward ratio, and it was. So the remaining shares up 14.73%. Okay. Here is bonds. Bonds have had a very, very difficult time. So in all the positions that I just showed you before, I place my emergency stop, I have my end of bar stop, I have my trailing stop level, I take partial profits. The majority of the trades that I take, this is my process. These are the rules that I follow. There is one exception. When I have what is called an abandoned baby, or I have a island reversal, which I'll show you here in a minute, I manage these differently. What I do is I place a 2 ATR emergency stop, which, as we know, if that hits, I'm going to lose 1% of my account. But on the other side, I place a 4 ATR profit target above. So, and then I let the trade run. So eventually, for sure, one way or the other, I'm either going to lose 1% of my account or I'm going to make 2% of my account. And this is kind of a set it and forget it kind of approach. I like it because it gives me a little diversification in the way that I manage the trades. So I want to bring your attention to these two bars here that I've highlighted in green. This is what's called a island reversal. And an island reversal happens when you have a gap down. You can see here on the 30th of July to the 31st, we have a gap down. So from the close to the open, bonds were bearish. The next day we had a sideways motion, didn't do anything. And then the very next day we have a gap up. The reason it's called an island reversal is because you see how it kind of leaves these two bars by itself like an island off of the coast. So gap down, day sideways, gap up. And what's important about this is you had a sudden shift in sentiment. You had the gap down, nothing happened, still bearish, and then you had this gap up. When you have a sudden shift from bearish sentiment to bullish sentiment, more often than not, you're going to see that market higher in the future. Not always, but more often than not. Now, when these island reversals or these abandoned babies happen, I don't generally buy them right away. I wait for a pullback and rejection of either the top of the abandoned baby or the top of the island reversal or the bottom of the abandoned baby or the bottom of the reversal. Those are the key support levels. So we have the island reversal, then we do pull back. I entered the position here on the 14th of August at 82.84. Why? Because it rejected the bottom of this island reversal. So I entered here 82.04. Again, the way I manage this trade, I place a 2 ATR stop and a 4 ATR profit target, and I just let it go. I'm not taking partial profits. I'm not going into trailing stop mode. I'm not doing any of that. I am just waiting. I'm either going to lose 1% of my account or make 2% of my account. But in my experience, I've been trading over 30 years. My experience is that with these abandoned babies and island reversals, more often than not, I'm going to make 2%, then lose 1%. So it's a good proposition. It is an edge. So again, I bought here 82.04. The very next day, it dumped against me, kind of recovered. Then we had this huge big up bar here on the 19th. And since then, we've come back down. Essentially, I'm completely even on the trade. Okay, I made 1 cent on this trade. But do you see how we created another island reversal here on the 18th? Why? Gap down, sideways motion, and a big gap up. So we've had 2 island reversals in a row. So we'll see what happens, right? I don't know what's going to happen. I just know if I make this trade 100 times, more times than not, I'm going to make 2%, then I'm going to lose 1%. So it's good. So anyway, this particular trade essentially break even. So we'll just see how it does going forward. UNG. Okay, well, let's see. What's the best way to show you this one? Well, this is good timing, actually. Okay, so we talked about the island reversal. But let's talk about the abandoned baby. Abandoned baby is the same as the island reversal. It's just 1 bar. So here on the 5th, from the 5th to the 6th, we had a gap down, okay? From the 6th to the 7th, we had a gap up. Same thinking, same idea. Gap down followed by a gap up. More times than not, you're going to see prices higher when that happens. Now, I didn't buy it when it happened. And you can see it did go up for sure, but I wait for those pullbacks and wait for a rejection of the top of the abandoned baby or the bottom of the abandoned baby. Here I entered at 983 on the 17th because it rejected the high of the baby. And because this is an abandoned baby or a island reversal, I use the same formula. I enter, I place a 2 ATR stop, I place a 4 ATR profit target, and I let them run. And then right after it happened, boom, went up, pulled back, down a little on Friday. So not a lot of management with these particular positions. And, recently I've had quite a few of these. And, I was thinking to myself, why am I having so many of these? It's just the type of market that it is. There's fewer order blocks. and there's more of these abandoned babies than island reversals. So therefore, when I take these, this is how I manage: 2 ATR stop, 4 ATR profit target. Just let it go, set it, and forget it. So on UNG here at the moment, the current trade is up 1.6%. And another example of abandoned babies. And, you know, this one is quite interesting. So I zoomed out here quite a bit, but let me bring your attention back over here, 330 of 26. I've highlighted these two bars here. This is a massive island reversal. Here on the 26th of March, we gap down. We have one inside indecisive day, and then the very next day here on the 31st, we have a huge gap up. This is a perfect island reversal, and it shows bear sentiment and out of the blue bullish sentiment. Usually when that happens, you're going to be higher. Well, that's exactly what happened. Now, I didn't buy this, but the top of this island reversal here, the 543 level, if in the future we come back to that level, is going to be an important support level. Well, it took off like a rocket ship, and then over the next few months, down, down, down. Where did it bounce before it had its next huge move up? That's right, at the top of that island reversal. That's what I'm saying. These are important levels. Okay, so I bought this position when that happened, and then I scaled out, got out as it went up, thankfully. Now we have come all the way back down. We went right through this island reversal. We bounced somewhere in this island reversal, but we have two kind of key levels here. We have the bottom of this island reversal as support. We have the top of the bottom of this island reversal as support, the top of this previous island reversal as support. So I've been talking about this level, excuse me, for quite a long time. Now, I didn't buy this one. I could have bought this one. I didn't buy it, and that took off great, and now it's come all the way back. I entered the trade on Friday at 549.89. Why? Because it rejected the high. See, I brought the high here, 543, all the way back from June into current day, and for the last 3 days, it has rejected that high. So does that mean for sure it's going to go up? No, but it has a pretty good precedence of bouncing when it comes back to this level. In addition to rejecting this, the top of this island reversal back in March, it also has the secondary support of this previous island reversal. So again, another trade, island reversal, where I entered 549.89, 2 ATR stop below, 4 ATR profit target. I'm just going to let it go. I'm very confident in saying eventually I will hit one of these two. For sure I will, right? But it will either be a 1% loss or it will be a 2% gain. And in my experience, more likely I'm going to make 2% than lose 1%. And so basically this trade, because I just entered, is completely break even. Okay, so let's just do a quick recap of the open positions. SPCX remaining shares up remaining shares up 16.08 on a order block and deep dip buy. Order block and V1. IBM remaining shares up 12.31%. That's a combination of a deep dip buy plus a V1. Intel remaining shares down 0.99%. That was an order block plus a V1. Tesla remaining shares up 14.73%. This was a combination of a deep dip buy, megaphone trend line, V2, and order block. TLT break even. This is a island reversal trade. UNG Also an island reversal trade up 1.60%, and Meta just took the trade completely break even. So those are the open positions. They're most of those are doing very, very well. But I did have to close out some positions this week as well. And let's start with Google. I entered Google here on the 18th of August at 344.20. Why? Okay, so this is a strategy that I haven't shown for a while. I haven't seen this happen for a while, but this is called a return to value. So let me bring your attention to this green line and this green line. You see this band of green lines that are moving? Anywhere below the top of this green line or anywhere above the bottom of this green line is called the value zone. In general, I like to buy under value and sell at value, or I like to buy at value and sell above value. What you don't want to do is buy above value and they get stopped out back at value. So the rules for this trade are, first, we need to have the price close above the value zone. Well, clearly it did here. The second rule is that we need to see the price come back in value. Remember, at the very least, I want to buy in value. And so it did come back in value. After that, I want to see the price move sideways. When it moves sideways, that means there's an equal amount of buyers or sellers. It's consolidating. And then once that happens, above the value zone, come into the value zone, then I need a few bars of sideways motion, and then I need a V1 or a V2 to trigger into the trade. Okay, so I took this trade here on the 18th with the V1. I entered at 344.20. I position size, I placed my emergency stop 2 ATRs below. But you may be asking, Greg, where is your end of bar stop? Well, your end of bar stop on a return to value V1 or V2 is a close below halfway of the number 2 bar, or we call this the washout bar, halfway. There's a key level there at 342.50. So I bought at 344.20. The next day during the day, it went under my stop, but closed back over my stop, keeping me in the trade. However, on Thursday, we did close below halfway the washout bar, and I had to exit the trade. So on this particular trade, I took a loss of 1.22%. And then Friday, right back up again. Oh, well, that's how it goes. So this one did not work. My rules told me to get out. I took a loss, 1.22%. Next trade was MO. I took MO here. That's Altria on the 13th of August at 65.10. Why did I take this trade? Okay, it was a rejection of the bottom of the order block. The previous day it closed under the order block. The day that I bought it, it closed in the order block. It also created a V2. So I got in at 65.10, position size, placed my emergency stop 2 ATRs below as always, and then my end of bar stop was simply a close back below the order block. Next 2 days later, it closed back below the order block. I had to get out of the trade. So I did end up taking a loss of 1.92% on this particular trade. The next day it closed back in the order block. I didn't take the trade again, and then it moved up and down. So but that's how it goes. But the point here is that, you're going to have losses. You're just trying to keep the losses small. And this was a loss. I did have to get out for a loss of 1.92%. And then the last one is CCL. I entered CCL here on the 12th of August at 26.27. We have an order block here, and inside the order block, we have the 200-day moving average, the black line. This is one of my favorite entries, where I have a rejection of a major moving average, a deep dip by moving average, inside an order block, a key level within a key level. So I entered here 27.67. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop on this trade is simply a close below the black line, simply a close below the 200-day moving average. And then I placed a trailing stop level 1.5 ATRs above. The next day took off. Great. Good start to the trade. At least I hit a couple profit targets on the move up, which is important because we came back down. So I was able to reduce my position, lock in some gains, which help mitigate the loss because then we turn back around. I had to get out here on the 18th because it closed below my end of our stop of the 200-day moving average. So on this trade, the remaining shares I lost 1.5% of the trade. But, not fun to take a loss. It happens. But am I glad that I got out and followed my rules? Yeah, clearly, because we are much lower now. So those are the three losing positions that I had to lock in. Google, a loss of 1.22%, MO, a loss of 1.92%, and CCL, a loss of 1.5%. So, taking losses in trading is normal. You're always going to have them. But what you want to do is you want to keep those losses small. And if you compare the three losing trades where losing 2% or less and getting out quickly, you can see I was not in these trades very long. If I'm not in a trade very long, it was because it's a loss. If I have trades like the open ones that are somewhere in double digits, I've been in these for weeks and weeks. And that's really what you want to do in trading. You want to be very impatient with your losers. If they're losers, I don't like it, I'm out. But if they are winners, you want to be patient and give them breathing room. And that's all comes down to your process. Do you have the rules that lets you stay in winning trades for a long time? And do you have rules that will get you out of losing trades very quickly? So I have losing trades all the time, but they're generally small and I'm generally out of them very quickly. The winning trades, the returns are much higher and I'm in there much longer. So that's the real takeaway. You're going to have winners, you're going to have losers, but hopefully your losers will be small. You'll be in them very short periods of time, but the winners, the ones that are working for you, you stay in there, let those grow. Be patient with the winners, be impatient with the losers. Okay, before we start taking a look at next week's potential trades, I just want to do a quick post here from Thomas Payne. Thomas is a great guy. I've known him for years. What's interesting about Thomas, he is a trader, but previous to this, he was a scientist, and he really brought the scientific method from his work as a scientist into trading and made it very scientific. So if you want to follow Thomas, please follow him at Trader T Payne on X. So I saw this post before I made the podcast, and as I was looking over what I was going to talk about today and taking profits and how important position size is, and I read this, I was like, oh, this is perfect segue. So let's see what Thomas has to say here. Larger trades draw in more emotion. More emotion creates clouded judgment. Clouded judgment creates mistakes. Therefore, larger trades create mistakes. Very good logic. And I 100% agree. I have told other traders, I've told my students for years, strangely, you always make more money with smaller positions. Shouldn't make a difference, should it? But it does. And the reason it makes a difference is because the larger positions draw in more emotions. More emotions create clouded judgments. Clouded judgments creates mistake. Therefore, larger trades create mistakes. Now, if you're disciplined enough to completely follow your process, regardless of if it's a small position or a large position, it really shouldn't make any sense. But we're human and it makes a difference. So, if listening to this, look back, reflect upon your trades. Have you made more money in general when you trade smaller than larger? I'll bet the answer is yes. Maybe it's not, but I would bet for the majority, the answer is yes. So there is nothing wrong with trading smaller than you think is correctly. I don't mind, if you trade 2 shares, perfect. Doesn't matter, but you're going to see that generally you're going to make more money with smaller positions because of the effect on your psychology. So that's why I'm saying it is so important to follow your process and your strategy. And so if you're one of those people that can have a larger position and follow your plan, perfect. Hats off to you. That is fantastic. But for the rest of us mere mortals, If it takes you, in order to follow your trading process correctly, if it takes you to buy fewer amount of shares to do that, perfect. Go ahead, do it. That is perfect. All right. But everything comes back to getting yourself a good trading process and then following it. And if to follow it correctly, if it takes trading fewer shares, I am totally okay with that. So anyway, Thomas, thank you very much for this. And again, you can follow Thomas at Trader T Payne over on X. Okay, let's get to the potential trades for this coming week. So I have identified 7 of these trades for next week. Now, they are not where they need to be at the moment. If they were, I probably would have already taken them, but they are definitely getting within striking distance. So I mention this each week, but listen, here I have 7 potential trades for next week. Monday, could all 7 of these trades trigger and be valid? They could. Theoretically, they could. Does it mean I would take all 7? 100% no. If all 7 of these trigger on Monday, I'm going to have to go through each 7 with a fine-tooth comb, and I'm going to have to narrow it down to the best trade. And so how do I do that? Well, in the simplistic sense, I give each one a scorecard. So if one had one entry signal, maybe I give it a score of 1. If the next one had 2 entry signals, I'd give it a score of 2. So I'd probably pick the one that had 2 compared to 1. But I may have one that has 4 entry signals, but has a bad risk to reward ratio. Okay, now I have to take points away from that because it doesn't have a good risk to reward ratio. I also look at higher time frames. If I'm trading the daily, I probably want to look to the weekly, see if I can glean some information on the weekly as far as, are there signals on the weekly? If there are, that gets extra bonus points, right? I also look at the relative strength of the market. If the market's down on the day, but one of these is actually up on the day, that gets an extra bonus point for having high relative strength compared to the rest of the market. So, it's a report card. It's kind of an algorithm that I use to come up with, all in all, what is the best trade on that day if I have multiple candidates. And this is how I trade. This is what I teach my students to do. And if I could just take a minute quickly and put in a plug for what I do. I'm a full-time stock and options trader, but I have been teaching for 10 years. I teach students all over the world. I teach them my formulas, I teach them my strategies, and I found the best way to do this is I have a 20-hour course, and it's a one-on-one course. It's not a big class. It's just a one-on-one course. It's just you and me. And the way that I structure it, I have a 2-hour class. You and I have a 2-hour class each week for 10 weeks. I teach you all of my trading approaches, all the rules. We do a lot of simulation trading. I throw a lot of curveball questions at you to make sure that you're understanding what I'm teaching you. But really, I love to teach. Like I said, I taught people all over the world, from absolute beginners all the way up to the hedge fund level in New York and everywhere in between. And I would love to have you as my student. If you are my student, I will teach you everything I know, and you will have a skill that you can use for the rest of your life. So if you're interested in doing that, please contact me. My email is in the link of this YouTube video, and we can get the conversation started. The 20-hour one-on-one course does cost $2,000. So I know it's a lot of money, but really it's an education and a skill that you're going to be able to use the rest of your life. And I think you'll be very happy and think that it was worth every penny. Alternatively, in addition to the 20-hour one-on-one course, I have a really good online video course available at udemy.com. In that video course, I teach you how the strategy and all the rules for the deep dip buy. You've seen me use that in some of these week's trades. And that's very affordable. It's somewhere between $30 and $50 on Udemy. And so that's a good place to start as well. And the link is in the description. So anyway, thank you for letting me put in my little plug. And let's get over to the potential trades for next week. Let's start with Berkshire Hathaway. This is Warren Buffett's company. You can see Berkshire had a really nice, huge move up here, but now it's coming back down. And we have a nice little order block here. Let's identify the order block. Swing low here, swing high here, swing low here, market structure change here. Okay, so market structure change happened, and Berkshire just took off to the moon. So when you look at Berkshire way up here at the top at $537, and then you look back here to where the order block was at $487, is it fair to say that smart money, now that we know it's here, is it fair to say that smart money was buying back here? And clearly smart money was buying there because they were buying there before the big takeoff. So the idea with these order blocks is this was once smart money. If in the future we come back down to that smart money area, does that guarantee it will be smart money again like it was the first time? And the answer is 100% no. It does not mean that at all. Things can definitely happen and change. But I can tell you from over 30 years of trading experience, more often when you get back to that previous smart money area, more often it is smart money again. But you never know. That's why you have to use stops and have your defenses up. But so we have this order block that was formed here on the 22nd. We bring it back in, smart money. Look, there's a lot of deep dip by long-term key levels inside this order block. There's the 200 there at 492.17. There's the 300-day moving average at 490.21. There's the 100-day moving average at 489.02. The whole idea with this is that you have these major moving averages, these key levels inside a key level of an order block. And that's really where the magic of this approach happens. The combination of the deep dip buy moving averages inside the key level of the previous smart money. So I have three levels that I'm looking at for next week here. The first would be a rejection of the 200-day moving average, 492.17. If it rejects that and gives me a good risk to reward ratio, I would be very interested in taking that trade. If that happens, my stop would be a close back below the 200-day moving average. Alternatively, if it goes lower and rejects the 300, okay, I may take the trade there and I would key off of the 300 as my level. Or if it loses both the 200 and the 300 and goes lower, I can key off this 100-day moving average at 489.02. So I have levels here. All I'm doing is waiting for a rejection of those levels, and whatever level it rejects, if that's the one that I take, then I will use that level as my end of bar stop. But I like Berkshire Hathaway, obviously, big company, smart people running this, and we've had this huge move up, and now we've had this sell off, but it is coming into this area. I think this is a smart money area, demand area, so I'll be looking for one of those rejections. Caterpillar. All right, simply, we have this abandoned baby here. The gap down, gap up. Where's the support level on abandoned baby? The high of the abandoned baby. Well, you can see on Friday we did reject it. I didn't take it because I took another trade, but I'm looking at this green order block here. I'm looking at the 200-day moving average inside here. I don't know if it's going to get there because it has this abandoned baby support here. But really what I'm looking for, because I don't really care about getting Caterpillar or not, but I just want to get in exactly where I want to get in, right? And exactly where I want to get in is a rejection of this 200-day moving average inside this order block. So really, I'm not messing with it unless it gets there. And the 200-day moving average is 758.83, key level inside the key level of the order block from the past. And then if it does reject the 200, then I will use that 200 as my end of bar stop going forward. So I don't know if it's going to get there. I'm going to watch it closely, but if it does, very likely I'll take the trade. Enbridge. Okay, I want to thank my friend Vivek for pointing this out to me. We have a order block from the past, and very similar to Caterpillar, we had this 200-day moving average inside the order block. Key level within key level. I mean, look at Enbridge. It was just a straight down move. Where did it magically stop? Oh, in the previous smart money area in the order block from the past. Now, I want to use a line in the sand. And right now, that is a close back above 200. But again, it's a key level, 200-day moving average inside the key level of the order block. So if Enbridge next week does close above the 200-day moving average at 50.68, I will certainly consider taking it. And my end of bar stop will be a close below that 200-day moving average. CarMax. You know, I was teaching last night. I have a student from Jakarta, and he wanted me to spend some time with him talking about short positions. And so we went through and I found this on CarMax. And so you can see this red box up here. So most of the boxes I have are green boxes, which are bullish order blocks, but there also is what is called a bearish order block. And we are currently right now in a bearish order block from this bearish order block that happened here 829.25. So right now we are in a supply area. So we are in an area where probably more likely than not we're going to go down. In addition to being in this bearish area, we also have a double top bearish MACD divergence. You can see the highs we have over here. The green MACD bars were pretty high. Now we are higher here than we were here, but the MACD bars are smaller, lower than the first. This means from a MACD perspective that the momentum is drying up. The buying momentum is drying up, and therefore, if buying momentum is drying up, you're running out of sellers. If you run out of sellers, you're going to go down. So the confluence of this particular trade is twofold. One, we are in a bearish order block. Two, we have a double top bearish divergence. So what would I be looking for an entry on this trade? Well, it happened on Friday. I just didn't take the trade because I didn't teach till the Friday night and I didn't know about this trade. I didn't see it. So had I taken this on Friday, I would have taken it because of rejection of the high of the order block. My stop would simply be a close above the top of the order block. Now, if Monday CarMax just goes down, I probably will miss the trade. But if it hangs up here and again rejects the top of the order block, very likely I would get short this trade, 2 ATR stop above, end of bar stop, a close above the top of the order block. But again, why thinking short? We're in a bearish order block, a bearish supply level with a double top bearish MACD divergence. More likely than not, when this happens, you head down. So again, I did not take this trade. I didn't see it during the day on Friday, but I'm going to be looking again for this next week for a potential short entry. United Airlines. Well, the airlines have had a tough go of it, and you know now I read today the Canadian, the U.S. Trade talks collapsed and so forth, and so anyway, this probably will not be good for United Airlines. So I very likely could see UAL down next week, but two pretty important levels here for UAL. You can see we have the green box, we have the green order block. This is a demand area. This is a smart money area. You can see, look, here's the order block back on June 10th. From there, 3 weeks later, we are extremely high. So again, I ask you, was smart money buying here when just a few weeks later we were this high? Yeah, clearly, in hindsight, they were. Okay, that means that in the future, if we come back to that smart money area, is it more likely to be smart money again? The answer, in my opinion, is yes. Not all the time, but more than not, it is. And so that is why I'm waiting to see if the prices come back into this demand area, into this smart money area, into this order block. Okay, so when I look at this order block, do I have key levels within the order block? I do. I have a 250-day moving average. That's the purple line at 106.21. I have the 300-day moving average, which is the orange line at 103.07. These are both deep dip buy levels. But again, the importance is that you have a key level. You have two key levels, the 250 and the 300, inside a key level of a previous order block. So I'm going to be looking for a rejection of the 250-day moving average or the 300-day moving average for a potential long entry. And then again, whichever one I use to get my long entry, I will use that as my stop to get out, my end of bar stop, if it closes below, to keep my risk to reward ratio good. Oil. All right. Well, speaking of bearish order blocks, we have a bearish order block all the way back from here from 6.3. I mentioned this weeks ago in the podcast that I mentioned, look, we have a bearish abandoned baby. What's a bearish abandoned baby? That's when you gap up and then immediately gap down. This is bearish because you went from very positive sentiment to very bearish sentiment very quickly. More times than not, when that happens, you will go lower. Was it right? 100% it was right. Nailed it. However, if you have a bearish abandoned baby, where is the key resistance level? The bottom of that baby. Well, I mentioned in the podcast, if we rally back up to the bottom of that baby, I would look for a short. Well, we certainly have rallied and we are within striking distance of the bottom of that baby. So what am I going to do with this trade? Well, at the moment, nothing. But if we end up rejecting the bottom of the baby, and the bottom of the baby is 138.14, I will consider, I need a rejection though, either a rejection at the bottom of the baby, 138.14, or a rejection of the high of the baby, 142.43. Either way, if either of those two get rejected and it gives me a good initial starting risk to reward ratio, I will consider getting short this. The way that I will manage that, I will get short and put a 2 ATR stop above and a 4 ATR profit target below and just let it go, set it, forget it. Eventually one of those two are going to hit. Last but not least is Walmart. Well, Walmart took a beating, just a beating. But we are getting to some key levels. We have a previous order block from the past that if you're looking up here back in like June, you would never think it would get here. Well, it's almost there. In addition to that, we have this megaphone trend line. And again, I'm connecting this swing low to this swing low, running that out into the future. In the future, if it makes a third touch on that megaphone trend line, more times than not, you'll get a reaction there. And just so happens that that megaphone trend line is very close to this previous smart money order block. So that's the confluence. So what I'm waiting for next week is either a rejection of that trend line or a rejection of the top of the order block or a rejection of the bottom of the order block. Now, if it rejects the trend line, I think I would consider taking that. Would my stop be a close back below the trend line? Probably not. Regardless of how I take this rejection of the trend line, rejection of the high of the order block, rejection of the bottom of the order block, if I take that trade, I'll probably give it a little breathing room and put my end of bar stop as a close below the low of the order block. And that low is about 98.50. So I still want to see it reject something before I take a swing trade on this. So anyway, everybody, that is what I have for you today. I hope you found it helpful. If it was, if you can take a second and hit the thumbs up button, I would really, really appreciate it. If I can help you with your trading in any way, just remember, I do teach private one-on-one lessons, 20-hour course, 2 hours a week for 10 weeks. Love to have you as my student. Have the udemy.com online video course for deep dip buy available as well. Both the information for that is in the YouTube description. Or if I can help you with anything else with trading, consulting, I help lots of people around the world, all sorts of things with trading. So if I can help you in any way, please contact me. I always like to leave off with, if you have the opportunity to go out and try to do one nice thing for a human being today, if you have the opportunity, take it, do it. They're going to appreciate it. It's going to be good for you as well. And I think if we all did that, if we had the opportunity and do that every day, the world would just be a better place. And I think we'd all agree it could probably be better. I'm also a big animal lover. And if you have the opportunity to do an act of kindness for an animal that comes across your path, please do it. They appreciate act of kindness just like we do. And you'll both be better off. They'll be happy. You'll be happy. It's a win-win situation. So I really appreciate you being here, everybody. I hope you did find it helpful. I hope you have a good rest of your weekend. And if I can help you with anything, please let me know. Any questions about anything I discussed today, just put them in the comment section. I'll do my best to reply. Thanks again, everybody. And God willing, I'll see you next week. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.